Hi, everyone. Thank you so much for coming today. I know it's probably been a heavy night for a lot of you. We'll try to speak softly for anyone suffering this morning. To start with...
Come on in, guys. Come on in.
Gather. So to start with, Mark, do you want to tell us a bit more about Scion Investments, what you're working on, and yeah.
Sure. Thank you, Emma, and thank you, everyone, for joining today. So Scion Investments, we are an alternative investment solutions provider to the wealth market. We focus on registered products that we think are very appropriate for individual investors. And as a platform, we serve the individual investor. That comes first in all of our ideas, all of our products, and our service. And we're vertically integrated from manufacturing of these products, managing them from an investment perspective and operationally, to marketing and distributing them. And we currently have 3 funds that we're very proud of. One is a publicly listed BDC called Scion Investment Corp, which is about a $2 billion AUM business. We have our flagship Scion Ares Diversified Credit Fund, which is a partnership between Scion and Ares Management, and that's approaching $7 billion of AUM, and it invests across the entire credit spectrum. And finally, we have our Interval Fund, which invests in infrastructure, and that's a partnership with Grosvenor Management out of Chicago. We're really excited about that, and obviously we're here to talk about that today.
Amazing. So, I've been reporting on the wealth management space for nearly 4 years now, and never has infrastructure been such a big topic as it is now. But at the same time, it is one of those terms that feels vaguely broad. You vaguely have an idea of what it is, but actually, do I really know what it is? So I guess, Mark, my first question to you is, what is infrastructure?
That's the million-dollar question, right? Because I think we all believe we understand what it is, but how does it work in the context of investing, right? If infrastructure, we get it, right? A toll road, a bridge, airport terminal, cell tower. We understand what that is in terms of it being a tangible asset, so to speak. But when it comes to investing in infrastructure and what distinguishes it from other asset classes, in my opinion, is sort of it's a 3-pronged approach. First, is it a tangible asset, right? Is it essential? Is it something that a business or a counterparty or a government needs to operate, right? So if you think about an airport terminal, you need that, right, to operate an airport, or if a road, you need that to transport cars and people across the country, across the state. So that is the first sort of prong. Essential asset is really what we're looking at. The second thing is we look at sort of the competitive landscape when we talk about investing in infrastructure. What is the competitive landscape like? Is there high barriers to entry? Is it a hard to access piece of infrastructure or an asset? And then is there some sort of maybe monopolistic element to it where it's really hard to compete? If you think about investing in a toll road, the M25 in the UK, right? No one's going to build another road there. It's going to be very, very difficult. And you have that contract with the government. So it's like you have a mini monopoly on that particular asset. And then we're looking at kind of the cash flows. Are they stable? Are they long-term? Are they predictable? So if we have those things, essential asset, limited competition, predictable cash flows, we're in the infrastructure world. And that's where and then we start thinking about, well, how do we get our return from that infrastructure investment? And to take it from there, how do we get the return really depends on the type of infrastructure asset there is, right? If it's a core infrastructure asset like a toll road, like a bridge, or something of that nature, well, you're going to get that return from a long-term contract with a government entity, quasi-government entity, something that you can really rely on, and you're going to underwrite your return based upon that 30, 50-year contract, right? And now you get into the core plus, the value add area, where you may have some element of predictable cash flows, but there is some growth story that you probably have to implement, or some improvements that you have to make to raise the level of revenue on those assets. And then you go all the way to the opportunistic, where you're just building something almost on spec, hoping that they will come, right? So you need your 3 elements, and then you need to look at how you get the return. And I think that's a little bit of different analysis than most other investments, whether that's private equity, whether that's real estate. There's a more nuance within infrastructure.
No, I appreciate that. Thank you. And I find your point about the kind of competitive is interesting. And you've brought up private credit, and you've brought up real estate, and private equity as well. So I'm just curious if you could kind of maybe explain an example where something that might seem like an infrastructure investment is actually, a private, a real estate investment versus private credit, and what makes it, truly a infrastructure investment?
So I think the first thing we like to point out in terms of how do you distinguish an infrastructure play between private equity or real estate is one that the infrastructure is less correlated to the broader markets, right? There's a lot of correlation today among the different asset classes, but when we look at infrastructure, it's a little less correlated because it kind of sits in between those two asset classes, if you will. And typically, a private equity firm or a real estate firm can invest in an infrastructure asset and infrastructure investment, but their underwriting is going to be more focused on growth. Right? That's how they're going to get their return. Where infrastructure investors typically are relying on these predictable cash flows, and they're underwriting to a more conservative level. So I think that's the distinguishing nature between the two, is that especially a private equity firm, right? They want to hit home runs. They want to get multiples of their investment back, and you're not going to see that in a stable cash flowing infrastructure investment. And then real estate, I think, is more about tenancy and cap rates and things of that nature, and that's a little different underwriting than what we would do in the infrastructure space. But there is certain similarities among the two, especially when you consider a value add infrastructure asset where you are underwriting some growth or some improvement, where you want that company to grow. Your initial investment is predicated on the cash flows that are visible today, and you have an understanding of how you're going to get return, but can you increase that return? Can you improve it? Can you increase the value of that asset by growing the business going forward?
No, that makes a lot of sense. Thank you. So it feels like, as I kind of said earlier, infrastructure recently has seemed to, it's the word on everyone's lips. It's kind of blown up in recent times, and it feels like as an asset class compared to, real estate and private equity, like I said, it feels a lot younger, a bit more infantile. Yet at the same time, infrastructure assets have existed since the beginning of time. Like, we've had roads for, thousands and thousands of years. So I guess my question is, why is it such a young asset class for asset managers, and why has the popularity suddenly blown up now?
Sure. So if you think about it, right, infrastructure has typically been funded by government entities, municipalities over the years. And if we look at today's environment, a lot of these municipalities, a lot of these governments, including our own, their balance sheets are a little bit stressed. Sure. So in order to really invest in infrastructure, they need this partnership. So you look at assets that have been around for many, many years, right? Tens, 20s, maybe 100 years that were initially invested in by government entities are now aging and now to be replaced, and these governments just don't have the capital to invest on their own. So you're seeing this public-private partnership really surface. I mean, we saw it the other day with SpaceX, right, or yesterday. That's a public-private partnership where we used to be in the business of sending rocket ships up to the moon, but now we look at private entities to help us do that. And it's the same thing happening in infrastructure. And I think that, long term, that's going to be the way governments do business. They're going to do business with private companies that have capital, that can do things more efficiently and understand the asset better. So that's what you're seeing changing today. The environment is opening up to private capital. The returns are getting a lot better. Historically, even when there was a private solution to a public infrastructure investment, it was more on the debt side, where you would finance the public bonds or something like that, and the yields were very, very low. So when it came to an investment opportunity for a typical investor, it really wasn't that attractive. But today, you're not seeing that. Today, you're seeing where we can invest at a level where the returns are attractive, the risks are moderate in most cases, and it's a great opportunity. And if you think about where private credit was, 10 years ago or more, everybody would tell you, no, credit's done by the big banks. It's done by the big banks. Why would I invest in your BDC? We heard that story back in 2011, 2012, 2013. And as we fast forward, alternative investment funds are now the bank, right? They are fueling the private credit boom. And it's the wealth channel that's helping us achieve that. It's not done just by large institutions. And I think you're going to see that same phenomenon happen in infrastructure investing, because there's just a huge funding gap, right? There's a huge funding gap, and the money's going to be required. And I think you're going to see this shift towards private capital, alternative investment funds really fueling the infrastructure movement.
I do want to come to you and talk to you about the importance of private wealth in kind of filling in this infrastructure gap. But before we do that, I kind of want to take a step back and maybe discuss what infrastructure looks like today in terms of, how does it look in America? And I assume, well, I don't assume, I know that some people perhaps are worried about how the current administration may affect infrastructure investing. And I would also be curious to know, because obviously you plan infrastructure investing for the long term, how do you manage that kind of, you don't have a crystal ball, so how do you manage long-term predictions versus kind of current short-term volatility?
So if we break that down into a couple parts, if we look at infrastructure investing here in America, it's all of the above, right? It's energy transition, which means traditional energy, natural gas, shale plays. It's renewable energy, wind, solar power, hydro, et cetera, et cetera. It's data centers, it's cell towers, it's storage, it's supply chain. It's really all the above. So there's a great opportunity here in the U.S. to invest in infrastructure. If we look at Europe, per se, Western Europe, it's a very mature market there. They have been very, very involved in developing infrastructure products, especially on the renewable side of the business. There's always been this government support of these projects with tax rebates and things of that nature that really fueled that economy. So it's a much more mature market, which means the returns are lower, the risks are a little bit lower. Where in the United States, we believe there's a lot of opportunity to capitalize on what's happening. And then if you look at Asia, Asia is not as up to speed, so to speak, as America or Europe, and there's obviously certain issues with respect to currency and local regulations that you have to take into consideration. And capital has been a little bit weary of investing in that part of the world, but I think that's going to open up. There's going to be good projects there across the board as well, and we'll look at that, but we're going to have to take into account the risk-return reward on that. When you talk about the current administration here in America, I think you're going to see where projects for natural gas, fossil fuels, traditional energy are going to be this administration is going to be very supportive of that, which is good for the space. Less supportive of energy transition, of renewable energy and the like. Not that they're going to stop people from doing it, but they're probably not going to make it as attractive, and they're going to make traditional investments in traditional energy much more attractive. But I think at the end of the day, they're going to have very little impact, positively or negatively, on the fact that infrastructure is needed. There's going to be a lot of investing in infrastructure, and I think any administration would have done the same, right? We're not really concerned about policies around this because we know that there's a major funding gap. We know that the assets are aging. We know that the private capital is going to be needed to make infrastructure successful going forward. So we feel very comfortable about it. But we think in certain asset classes we'll see maybe more support, or there'll be more permits issued. So therefore you need more infrastructure. So that'll fuel the energy boom, the traditional energy boom. And then the other side of the equation, it really comes down to, are these projects economically viable, right? Do they give investors a return? The days of getting government subsidies and things of that nature, that's not what's driving us as investors. What's driving us is, does the project make sense? So as innovation advances and it makes wind and solar more cheap and more affordable to do, you're going to see investment in those asset classes too, regardless of what administration is out there or what the incentives are to do that. It's about making the projects economically viable where we can get investors a good return on their investment.
No, thank you. So you've mentioned a couple of times about the importance of private capital in filling this gap. And I believe I have a stat from the American Society of Engineers, and they say it's going to be a gap of about 3.7 billion between 2004 and 2033. So my question is, of that 3.7 trillion, of that 3.7 trillion cap, what percentage of that do you predict will have to come from the private wealth market?
prediction on percentage is tough for me to say, but
Sure.
it's going to be an all of the above solution, so to speak. So it's going to take traditional institutional capital. It's going to take, obviously, government, quasi-government capital as well to a certain level, although that'll be a smaller portion of what's needed. And private wealth is going to be a major component of it. Again, we talk, if I look at my business or we look at the industry today and the amount of capital that's being raised annually by these alternative investment funds, if we were here talking 20 years ago when I started our business, people would have laughed at us,
Sure.
right? They did laugh at us. They say, well, why are you in this business raising money from retail investors? You can go fly to Asia or London and raise, $100 million in one trip. And we saw a real opportunity. We saw an opportunity not only to service individual investors and give them the ability to play on a level playing field and get the same benefits that institutions had been getting for many, many years. And it took innovation in our industry, such as the interval fund wrapper and the BDC, to really allow individual investors to invest in alternatives on the same terms and conditions, getting the same deals, not being cherry picked, not getting the scraps, and that has just changed the market tremendously. So the private markets are much bigger than the institutional markets as a whole. So as we educate our advisors, as we educate their clients, the investors, about the benefits of alternatives and these strategies that are in place, the structures that we use to help facilitate the investment, the capital that comes from private work can eclipse what's coming from the institutional side. So it could be a major, major component, especially for the areas of the sort of core plus value add, core plus value add, because the risk profiles are appropriate for the wealth channel, right? They're appropriate for the individual investor. Now, if you want to talk about opportunistic and some of the more aggressive plays within infrastructure, that'll still probably be left to the bigger risk takers, the bigger allocators of capital. But private wealth is a major component of the investment landscape. It's a major component of my business is 100%. Private wealth, individual investors. But if you look at the big names out there, the Blackstones, the KKRs, the Apollos, private wealth is becoming the engine that's going to fuel those businesses into the future. They're more focused on servicing the individual investor right now than they are the institutional in some ways. Their institutional client still is it's still their backbone. It's still where their bread is buttered, so to speak. But they believe in the opportunity. They believe in the power of the wealth channel. And I think we're going to see wealth really fuel a lot of different movements as we go forward within the alternative investment space.
Sure. We kind of talked earlier about, how young infrastructure is as an asset class. And, like you say, 10, 15 years ago, and even now, to be honest, some private wealth investors, feel nervous about private equity and other places. So I'm just curious, because obviously this is newer and probably less familiar to people. What challenges have you had when talking to, private wealth clients and advisors about investing in infrastructure? And what would you advise to advisors who are trying to, sell these assets? What would you say, how would you advise them to kind of go about it with their clients?
So sure, there are definitely hurdles to overcome, right? To convince advisors and their clients to invest in what appears to be, as you mentioned, a relatively newer asset class for the wealth channel. I would say the first thing to understand is that in a diversified portfolio, we believe infrastructure plays an important role. If we look at historical returns within the infrastructure asset class compared to other traditional asset classes, private debt, private equity, the stock market, you'll see where infrastructure really outperforms in both inflationary periods and in downturns, right? And it's the nature of the investment, right? It's less sensitive to the economic conditions out there because, as we said before, these are essential assets. They have to be used. There's predictable cash flows. There's less upside, but the benefit of that is that the downside is more covered, and you can drive yield in a portfolio when the markets are volatile. So if we look at an allocation of infrastructure to a traditional 60-40 portfolio, we're seeing where you can enhance, depending on how much you do, 5%, 10%, 15%, you can enhance returns by as much as almost 100 basis points and lower risk by 50 basis points. Sure. So there's a place here, and I think that's why advisors are attracted to learning more about infrastructure. The obstacles really stems from education. And, we're seeing that across the board in all alternative investments. As much capital is being raised in the alt space, in private credit, in the interval fund structure, we're still just scratching the surface. And a lot of advisors still are not either comfortable with the asset class, they're not comfortable with the structure. And what we're seeing is as they become more educated, they are warming up to it, and they really truly understand and see the benefits of this investment vehicle or these types of strategies in their portfolio. And just as an aside, with the interval fund has grown tremendously, right? There were probably 20 interval funds back in 2015 to 17. When we launched ours in 2017, there was like 30 plus, maybe 35 interval funds. Today, there's over 110. There's another 80 in registration. Right. So you're seeing that there's an adoption of it, that the market's growing, that advisors really understand how to utilize that investment structure. And the investors really like the idea of being able to invest in alternatives, right, and not be subject to the traditional limitations of alternatives, the high minimums, the lack of transparency, the lockups, right? So in an interval fund structure, in a perpetual BDC right now, managers are offering that limited liquidity, and there's transparency in the interval fund product. It's a daily NAV, so you're seeing the value of your investment on a daily basis. So there's a lot of redeeming qualities to it, and education is really driven, I think, that demand by the advisors and supply, right? And I think you're going to see the same thing over the long term on infrastructure. It's about educating them on the asset class. We're here today trying to explain it because it is a new concept for a lot of people. It's hard to get your arms around, and that's one of the impediments, is that advisors can't put it nicely into a bucket. Sure. Right? You have fixed income, you have private equity, private debt, you have equities, and infrastructure is kind of where do I put it, right? And I think initially it's going to take advisors to be a little creative and say, well, I'm going to put it, in this bucket or that bucket, or I'm going to be innovative and create a new asset class. And I think that's what's going to happen, right? Sure. Over time, the asset class will surface, and people will understand, well, I'm putting infrastructure in my portfolio to be more of a ballast, to hedge against inflation, hedge against downturns, and then I have my private equity for the upside. I have my private credit for the pure income that I need to generate in my portfolio. And real estate will come back, and real estate will give you another exposure, a different way to get returns in different market environments. And then you have your traditional, public investments, your fixed income, your bonds, your bank loans, your stocks, and that's how you're going to create a balanced portfolio with these types of asset classes. And we're going to see, we think, a migration to more alts, right? A higher percentage of alts. So it's just really about educating advisors, working with them to figure out how do you position it in a portfolio. And I think you're going to see a lot of interest in the asset class because, listen, people have been very bullish on private credit. We're still very bullish on private credit. Sure. But there's only so much an advisor can do in their portfolio, right? They need to look to other asset classes to provide yield, diversification, and mute some correlation. And real estate hasn't been there. Real estate's been that product for so many years. And, the real estate is not as attractive as it was. It'll come back. But we think infrastructure really, really gives advisors something that they've been missing in their portfolio. And hopefully they'll agree with us on that.
Perfect. Now, I don't know if you guys can hear this, but there's been a seagull trying to very angrily argue with Mark. So I just want to remind people we will have questions 5 minutes towards the end. So, feel free to put them on Slido. We'll answer them. So, Mr. Seagull, please wait. Anyway, one thing I wanted to come back to you on is you're talking a lot about the advantages of the interval fund and kind of the growing popularity. And I understand that your infrastructure fund will be in that interval format. And I just wanted to know why it is that the interval fund is better for this particular asset class than other types of evergreen funds. I know you talked about the daily NAV, but I'm pretty sure there are other evergreen structures that offer daily liquidity. I know with tender offer funds, there's issues with gating, but I'm just curious to know your thoughts why you felt that was the best fit for your investors and for private wealth investors in general.
So we're big proponents of the interval fund. We think it's what's really been a game changer in the space and has allowed for the democratization of alternative investments. And as I said to you before, our company, Scion Investments, we are focused on the individual investor, and we want to make alts accessible to everyone. That's really our goal. And the interval fund wrapper is the vehicle, is the vessel that allows that to happen, right? If you're an ultra high net worth individual, you may have been investing in alternatives for a while now, right? Through a traditional alternative LP, GP LP structure where you have to invest $5 million and you get locked up for 7 to 10 years. And that's just not available or appropriate for most individual investors.
Sure.
So when we look at the opportunity, when we look at our business and how can we best serve our client, we think the interval fund wrapper really checks all the boxes, right? You have a registered product, there's transparency, it's regulated, you have limited liquidity, I like to call it appropriate liquidity that allows the investor to access their capital, okay? It allows us as investors to take advantage of the liquidity premium that's available to them. And that's what we're trying to do with alternatives. We're trying to give investors the opportunity to capitalize on the premium that illiquid investments produce.
Sure.
And you can't do that in a liquid wrapper. And then obviously you can do that in a traditional illiquid wrapper. But again, that's not appropriate for most investors. So when you consider the features of the interval fund, they're very similar to a mutual fund. You have a daily NAV, you have transparency, we're doing third-party valuations on the assets that we have. Up to 5% per quarter of NAV is available for tender, and that's significant, right? We haven't had any issue, thank God, with our interval fund. And remember, it's 5% of the NAV. It's not 5% of your investment. Sure. So if historically, with respect to our Scion Ares Diversified Credit Fund, and we've been doing it for almost 8 years now, if you want to get your money out, you got your money out, right? But most of the time, advisors and clients are in liquid investments, and they don't need the liquidity, right? And they're leaving money on the table. And what's happening is they take some sort of security in that liquidity and being able to push that button, but when they need it or want it, it's really not available,
sure,
right? Because the market turns upside down, asset prices fall precipitously, especially in the liquid space, and you don't pull the trigger.
Right.
So why not get 300-400 basis points more in a product that does give you some ability to get your money out? And even if there was a high demand for tenders and the limitation is hit, the 5% is hit per quarter, 20% per year, you still have a pathway to the exit. Like, you can still get your money out. Where in a traditional illiquid, you may never get your money out, right? Or you're going to get extensions, and for what? What was the premium that you were going to get in that vehicle, and what was the risk that you were taking? Interval funds are very low levered. Our infrastructure fund will incorporate no leverage, and I think it's just a more prudent way for retail individual investors to approach alternatives. So we're a big proponent on it. Our credit fund is structured that way. Our infrastructure fund is structured that way, and we'll probably come out with more in the future because we think it's a great vehicle. Now, the thing I will say is that as an advisor, you do have to really understand what's happening inside that wrapper, because all interval funds are not the same, right? On some level, you can say, well, maybe mutual funds are very similar because all the assets are liquid, right? Yeah. They're very, very liquid. Well, you can have different types of investment strategies in the vehicle, and what you have to do is you have to make sure that the investment style really meets the features of that wrapper, of the interval fund, right? And are the assets going to be able to produce enough income? Are they tradable enough? Is there strategies to produce liquidity within the investments so that you can satisfy your tender program?
Sure.
Do you have lines of credit that are available? How successful have you been at raising capital in these evergreen products? raising capital in evergreen products is critically important because that ongoing flow of capital really fuels the business. And what happens is if you stop raising capital and you start getting your 5% tender, 5% tender, 5% tender, well, now things could be problematic. That's the risk within the product. But if the strategy is diverse enough, if the manager is high quality enough, can source enough opportunities, if the franchise that is marketing and distributing the product can raise capital, has raised capital, and performance is there, these are really compelling products for an individual investor.
Sure, that makes a lot of sense. Earlier, you kind of touched upon, the different, infrastructure, the landscapes in different regions such as Asia and Europe. And, I talk to a lot of wealth managers, and the big thing that they say, particularly on the real estate side, is, people like to point to a building and be like, I built that. So I'm just curious to know, how is it in the private wealth space that you go about investing in in infrastructure? Do you look at it from a global perspective? Do you look more regionally? And what are the advantages of your approach as well?
So we're a global investor. We look at infrastructure globally. We think that that's the right approach because there's great opportunities in all the regions that we talked about. And we also believe in diversification. That's one of the hallmarks of everything that we do with respect to our interval funds is we want to be highly diversified because we think it's important. It limits risk. It helps facilitate, like I said before, the idea of giving liquidity to investors. So that's very, very important. And yeah, we think the difference between, I think, real estate, they say location, sure. Right? So I think it matters more in the underwriting. Certainly from a sales perspective, real estate was a much easier sell when you were walking into a financial advisor's office and showing a big shiny picture of a Walmart or a Home Depot, and like I shop there, and they get it. But I also believe they get infrastructure, right? If I said, well, we invest in, we own the Terminal A at JFK Airport. Like, they know what that is.
Sure.
Like, wow, okay, I fly out of JFK. I get it. I see all the stores. I know how you get, you make your money. You get the rents from the stores, and those stores are all good quality stores. You have a captive consumer base that comes in and out of there every day. You get landing fees from all these airlines. So I see how that happens, right? Or even if it's not local and it's the M25 in London, you say, well, I've been there, or I've heard about that. And yeah, people need to use that road. So I think it has a lot of the same dynamics. I think people are more familiar with the asset because real estate is very homogeneous, right? It's real estate. So how do I distinguish one real estate piece from another real estate? Well, it's the brand on top of it. Where infrastructure is not about brand, right? Infrastructure is about the underlying asset and the business it conducts and the revenues it generates. So I think investors, advisors can relate to infrastructure even if it's not local, even if there isn't a brand behind it. And I think that's the difference. The brand really helps in real estate where I don't think it matters in infrastructure.
No, I think I do agree, but I'm also curious to know your thoughts on, because obviously we've kind of touched upon, the definition of infrastructure, and it's such a broad and ever-evolving term. So, about 10 years ago, we wouldn't have thought of, AI solutions and like the things around technology as potentially a part of infrastructure. But, as they become more and more essential to everyday lives, a lot of managers now put those in those boxes. So I wonder if you've ever had the experience or what you think private wealth clients might think of, versus, I built this building in my neighborhood to I'm helping the infrastructure in this small town in China. Do you know what I mean? It's like more esoteric to them. And I was just wondering, do you think that matters for private wealth clients?
Listen, I think certain clients may look at your portfolio and say, I don't get something, or if it's a client that is into sustainability, right? They may look at your private equity portfolio or your credit portfolio and say, well, those are great investments, but I don't like who they're with, right, or what they stand for. So I don't think so. And listen, at the end of the day, with respect to our interval fund, you're going to have a large majority of that in U.S. assets, Western European assets, not in esoteric places in Asia. So it'll be, I think, a smaller part of it, and the stuff that is in there, the terminals, the toll roads, the aviation companies that we invest in, the FBOs that people are familiar with, the cell towers that provide the connectivity for mobile phones and things of that nature. I think will be very, very familiar with them. I think they'll understand. I tend to think they'll understand that a little bit better at the investment level than some of the things we do in private credit or in private equity. But yeah, I mean, it helps, right? Marketing is key, and we as a firm, not only do we have to do really good at investing the capital, that's the priority, but we have to do a good job of promoting it and marketing it, and yeah, I think that was always. Even with private credit, we always had a struggle competing against real estate because we couldn't show the picture, right? We couldn't show the Home Depot. But now people have understand that the underlying investment is very sound, and it's a great part of an alternative allocation to our portfolio. And they understand that bank gives people money, gives company monies, they get paid back. You get a return of your capital, a return on your capital. And now it's not really about necessarily saying it's this company or that company. It helps if you have a brand name in your business. Like we have Rawling baseballs at our booth over here because Rawlings was a portfolio company of ours. We have, and it's not the infrastructure fund in our credit fund. We have Rydell, the football helmet company. And if you talk to an advisor whose son plays football, well, they may gravitate towards that and resonate with that and maybe helps them understand it better. But I think within infrastructure, there are going to be enough assets in there that are traditional infrastructure assets that are in a location that people are familiar with and maybe they have used them before. So I think they'll get it from that perspective.
Sure. So other than investing in your fund, which you should all do, by the way, it sounds great. But other than that, I'm just curious, what advice would you give wealth advisors who are perhaps approaching this space for the first time, what to look out for? What should be the kind of criteria for them to kind of onboard these new funds and work with new asset managers?
So listen, I would say get educated, right? Learn as much as you can about the space because it is an important part of your business. Clients want alternatives in their portfolio, and there are ways to do it today, right? The accessibility is becoming greater and greater. And there are a lot of really good managers, right? There are a lot of good managers out there that are bringing these products to market. And if you look at the landscape, the returns or the performance or the track record of the different managers they're close, right? They're close. Maybe some outperform a little bit than others, but you're not seeing this dispersion with track record, right? So it really comes down to what is the strategy? How are they doing it? What wrapper are they doing it in? What kind of service am I going to get from that partner, from that sponsor, right? Because your business as an advisor is a chaotic business. You have a lot to do, right? So you need a partner that can help you through the good times and the bad times, can service you in an appropriate way, educate you, give you updates on the markets. If things are going the wrong way, why are they going the wrong way? What's the view in the future, and how are things going to settle? So I think that's important. But obviously you have to diligence the manager. They need to have a track record, and there's a lot of choices out there. And then really understand what's happening under the hood, right? What are they telling you they're doing, and how are they really doing it, right? So if you're in an interval fund where there's liquidity, there's a liquidity feature, and you're looking for diversification and things of that nature, make sure they can do that. Can they originate the investments, right? Do they have that ability? If they grow, a lot of capital comes into the product, are they going to be able to put to work? Right? That's a big issue right now. There are a lot of funds that are raising a lot of money that start to style drift, right? They tell you you're doing one thing, and then they start doing another thing. Or there's smaller firms that are really good at what they do in terms of investing, but they haven't done it in scale, right? And if they raise a lot more money, can they originate those deals? So I think there's a lot of moving parts, but that's what we're here for. We're here to educate you, to give you an idea what the landscape looks like, and we're very transparent with our advisors and our clients. We tell them the differences between all the funds, and we don't expect everyone to give us all their money.
Sure.
But at the end of the day, we want advisors to be well informed, and we do that through programs, through our education program, through our training programs, so our people are as versed about other people's products as they are as our own, right? So you can understand that. But again, the education is critical. Really looking at these assets, I think, is critical for your business, and it really comes down to finding a good manager, which they're out there, the right wrapper for your clientele. If you have ultra high net worth individuals that like really esoteric investments, well, you can go the illiquid route, right? But if you have someone who wants those a little less more risk adverse, wants some liquidity, then the interval fund wrapper is a great place to go.
Perfect. We are just out of time. Thank you so much for Mark speaking to me. It's been a really great conversation. I should clarify, I am not qualified to give investment advice, so please look into the fund if you like it. But yeah, anyway.
Thank you, Emma. Thank you, everyone.
Thank you so much.